Welcome back to Accounting 101. We're going to cover Chapter 7, Fraud, Internal Control, and Cash. Learning objectives: define fraud and the principles of internal control, apply the internal control principles to cash, identify the control features of a bank account, and explain the reporting of cash. So a lot less debits and credits and entries. We'll have a few of those in this chapter, but it's more theory and discussion about fraud and the internal control features. So fraud is a dishonest act by an employee that results in personal benefit to the employee at a cost to the employer. The three main factors that contribute to fraudulent activity are depicted in the fraud triangle. It's opportunity, financial pressure, and rationalization. And we'll talk more about that as we go through and see some examples. But they have to have the opportunity to commit the fraud. They have to have financial pressure, personal financial pressure to the employee, and some sort of rationalization of why it's okay to do what they're going to do. Sarbanes-Oxley Act. It applies to publicly traded U.S. corporations. They are required to maintain an adequate system of internal control. Corporate executives and boards of directors must ensure that these controls are reliable and effective. Independent outside auditors must attest to the adequacy of the internal control system. And the Sarbanes-Oxley Act created the Public Company Accounting Oversight Board, PCAOB, PCAOB, that's what they say, which is really the auditors of the auditors, is a good way to think about it, as they ensure that auditors are following the right steps and that their testing of companies is adequate in itself. Sarbanes-Oxley Act was created by Congress really after the implosion or debacle from Enron. So if you're not familiar with Enron, Google it, read about it. There's an interesting book that I just recently read. It's called The Smartest Guys in the Room. I think there's the movie about that as well. But they were acting unethically and doing a lot of things off balance sheet. A lot of people invested money into that firm and then or into that corporation, and they ended up declaring bankruptcy and going out of business, and a lot of people lost a lot of money. So Sarbanes-Oxley, they're two congressmen. One actually wanted more controls. One joined in to try and limit the controls that the act put in place, and that's what came about from the Enron debacle. Internal controls are very important. It's to safeguard assets. It's to enhance the reliability of accounting records, and it's to increase efficiency of operations and ensure compliance with laws and regulations. So even if you're not following Sarbanes-Oxley, you're not a U.S. public company, having strong internal controls is important, and it's a way to make sure that your financial statements are going to be accurate. 5 primary components of internal control: a control environment, having a risk assessment, having control activities, information and communication, and monitoring. So these are the components. You have to have an environment that's, a control environment that is saying that, yeah, the company wants to make sure that they have controls and everybody from top management down understand that. You do a risk assessment of the business. Certain aspects of businesses are more risky depending on the type of business. So if you're a restaurant, for example, handling cash, so cash is more risky than a company that just does business-to-business transactions and you're not really handling cash as much. So the risk of cash is different. So having that assessment to define what's risky for your company. Controls activities is activities to make sure that the controls are in place. Information and communication is reporting out on those controls and communicating what's happening with the business, and then monitoring those controls, having some independent oversight to those controls. Establish of responsibility. This is a control that's most effective when only one person is responsible for a given task. Establishing responsibility often requires limiting access only to authorized personnel and then identifying those personnel. So here's an example here, transfer of cash drawers. It's your shift now. I'm turning in my cash drawer and heading home. So having only one person responsible for the cash drawer kind of controls that. So if cash is missing or there's excess cash, that person is responsible for it. If multiple people are interacting with the same cash drawer, you don't know who potentially committed fraud against that. Here's an example. Maureen Frugali was a training supervisor for claims processing at Colossal Healthcare. As a standard part of the claims processing training program, Maureen created fictitious claims for use by trainees. These fictitious claims were then sent to the accounts payable department. After the training claims had been processed, she was to notify accounts payable of all fictitious claims so that they would not be paid. However, she did not inform accounts payable about every fictitious claim. She created some fictitious claims for entities that she controlled. That is, she would receive the payment, and she let accounts payable pay her. So it was $11 million that she stole from the company. The missing control is the establishment of responsibility. The healthcare company did not adequately restrict the responsibility for authorizing or approving claims transactions. The training supervisor should not have been authorized to create claims in the company's live system. Segregation of duties. This is different individuals should be responsible for related activities. The responsibility for record keeping for an asset should be separate from the physical custody of that asset. So here's an example. The accounting employee maintains cash balances per the books. So they're creating the journal entries and reconciling the bank account. The assistant cashier maintains custody of cash on hand. That person is responsible for counting the actual cash, making bank deposits, that type of thing. So we're separating the duties. So not one person isn't responsible for counting cash and then also recording journal entries because they could commit fraud and steal some cash. So establishment of responsibilities and segregation of duties are linked and they're similar, but there is a distinction between the two. Lawrence Fairbanks, Assistant Vice Chancellor of Communications at Aesop University, was allowed to make purchases under $2,500 for his department without external approval. Unfortunately, he also sometimes bought items for himself, such as expensive antiques and other collectibles. How did he do it? He replaced the vendor invoices he received with fake vendor invoices that he created. The fake invoices had descriptions that were more consistent with the communications department's purchases. He submitted these fake invoices to the accounting department as the basis for their journal entries and to accounts payable department as the basis of payment. He was able to take $475,000 from the university. Segregation of duties is the missing control. University had not properly segregated related purchasing activities. He was ordering items, receiving the items, and receiving the invoice. By receiving the invoice, he had no control over the documents that were used to account. He had control over the documents that were used to account for the purchase and thus able to substitute a fake invoice. So a way to fix this is if the invoices would go directly to the accounting department, so they would see the invoices and it wouldn't go through someone else at the company or in the university in this case. Potentially setting up the receiving differently, having someone else look at the receipts so they knew what was coming in was what was being invoiced for and that type of thing. So a couple different things they could have done there. Here's another example. Angela Bauer was an accounts payable clerk for Agassiz Construction Company. She prepared and issued checks to vendors and reconciled bank statements. She perpetrated a fraud in this way. She wrote checks for costs that the company had not actually incurred. for example, fake taxes. Supervisor then approved and signed the checks. Before issuing the check, Angela would white out the payee line on the check and change it to personal accounts that she controlled. She was able to conceal the theft because she also reconciled the bank. That is, nobody else saw that the checks had been altered. She was able to take $570,000 with this control. Again, segregation of duties. They did not properly segregate record keeping from physical custody. She had physical custody of the checks, which essentially was control of the cash. She also had record keeping responsibilities because she prepared the bank reconciliation. So they had good controls where she would provide the invoices, supervisor approved and signed the check, so there was a good control there. But the check should have just been mailed directly out. They should not have gone back to the person who was requesting the checks. In this case, Angela, she had physical control and she could alter the checks. And then if they had somebody else doing the bank reconciliation, they might be able to caught that the checks were altered. Documentation procedures. Companies should use pre-numbered documents and all documents should be accounted for. Employees should promptly forward source documents for accounting entries to the accounting department. So in this example here to the right, pre-numbered invoices. So having invoices that come to the company already numbered and the numbers match what they're recording. They can see if one is missing pretty easily or if one gets out of order or that type of thing. So that's helpful. In computer systems today, a lot of times the invoice is computer generated. So there's a record of the invoice number and it's generated with the sales transaction and then printed on the invoice. So they're not using pre-numbered invoices, but using the pre-numbered invoices is a good control if you don't have that computer system. It's also a way that people can get in trouble. I had someone I knew from college, started her career in an accounting firm. Part of their control for getting reimbursed for expenses is they would have to turn in receipts. So if they took a client out to dinner or out to lunch, and then they would need to turn in a receipt for that. If they were traveling, sometimes you got to expense lunches. If you went to a deli shop or something, you may not get a receipt, run through McDonald's drive-through, lose your receipt, something like that. Legitimate expenses that she should have been reimbursed for, but what she had done had gone to a office supply store and got some receipts that you might see at a diner where the tear-off tab at the bottom, pre-numbered, of course, and she would, when she didn't have a receipt, just use that as kind of proof and turn that in. Again, she wasn't committing fraud because it was a legitimate expense that she was trying to get reimbursed for, but she didn't follow procedures. She got in trouble because they audited the expense reports and realized that she was turning receipts in that were in order using the pre-numbered receipts that she had. So it's a way that the pre-numbered actually helped the auditors catch a violation. Again, not fraud, but a violation of the policy, and she got in trouble for that. Mod Fashions. So to support the reimbursement request for travel costs incurred, employees at Mod Fashions were required to submit receipts. It's a very common requirement for companies. The receipts could include detailed bill provided for a meal, credit card receipt provided when the credit card payment was made, or a copy of the employee's monthly credit card bill that listed the item. A number of the designers who frequently traveled together came up with a fraud scheme. They submitted claims for the same expenses. For example, if they had a meal together that cost $200, one person submitted the detailed meal bill, another submitted the credit card receipt, and a third submitted a monthly credit card bill showing the meal as a line item. Thus, all three received $200 reimbursement. So they were able to take $570,000 with this fraud scheme. Documentation procedures was the missing control. They should require original detailed receipt and only that for reimbursement. Should not accept photocopies, should not accept credit card statements. In addition, documentation procedures could further be improved by requiring the use of a corporate credit card rather than a personal credit card for all business expenses. The other way that I've seen this control be enhanced is when you submit a meal receipt, you have to list who was at the meal, and the most senior person at the meal is supposed to be paying for it. So if I went to a meal and I had people that were my same level or below me, I could be the senior person. I would have to pay for that. I would list who was at the meal. If somebody else tried to submit the same reimbursement, they listed the same people, or if they listed someone that was superior to them, a higher level, the auditors could catch that and question the legitimacy of that expense and probably deny it. So there's different ways that they could also improve that. Physical controls. Okay, physical controls are things that you think of: safes, vaults, safety deposit boxes for cash and business papers, locked warehouses and storage cabinets for inventories and records, computer facilities with passkey access or fingerprint or eyeball scans. So now we're getting into, it's a physical control, but it's, passwords and that type of thing. Alarms to prevent break-ins, television monitors and garment sensors to defer theft, time clocks for recording time worked. Okay, so not only locks and buildings, but also, the passwords and, having ID cards for helping with the time clocking in and out and that type of thing. Centerstone Health, a large insurance company, the mailroom each day received insurance applications from prospective customers. Mailroom employees scanned the applications into electronic documents before the applications were processed. Once the applications were scanned, they could be accessed online by authorized employees. Insurance agents earn commissions based upon successful applications. The agent's name is listed on the application. However, approximately 15% of the applications from customers who did not work with a sales agent. Two friends, Alex, an employee in record keeping, and Parviz, a sales agent, thought up a way to perpetrate fraud. Alex identified scanned applications that did not list the sales agent. After business hours, he entered the mailroom and found the hard copy applications that did not show a sales agent. He wrote in Parviz's name as the sales agent, then rescanned the application for processing. Parviz received the commission and then split it with Alex. So $240,000 from this fraud. Physical controls is the missing control. Two basic physical controls that were lacking that could have prevented this. The mailroom should have been locked during non-business hours, and access during business hours should have been tightly controlled. Second, scanned applications supposedly could be accessed only by authorized employees using their passwords. However, the passwords for each employee was the same as the employee's user ID. Since user ID numbers were available to other employees knew other employees' passwords. So not a very good control there. Unauthorized employees could access the scanned documents. Thus, Alex could enter the system using another employee's password and access the scanned applications to identify which ones he needed to alter, get into the unlocked mailroom, and alter the documents. So physical controls there would have helped and prevented this fraud. Independent internal verification. So records periodically or on a surprise basis verified by an employee who is independent. Discrepancies reported to a management level that can take appropriate corrective action. So we talked about the segregation of duties. In this top box here, the accounting employee that maintains the balances per the books. The assistant cashier maintains custody of the cash on hand. Then we have a third person, in this case assistant treasurer performing an independent internal verification. So they make monthly comparisons. The reports um, that the assistant cashier said was the cash on hand versus the cash balances per the books that the accounting employee was maintaining. And the assistant treasurer would look and compare those. Any discrepancies they could take to her boss, the treasurer, and for further investigation and corrective action if needed. So Bobby Jean Donnelly, the office manager for Vermont Fashions Corporations, was responsible for preparing the Design Center budget, reviewing the expense reports submitted by the Design Center employees. Her desire to upgrade her wardrobe got the better of her. She perpetrated a fraud that involved filing expense reimbursement requests for her own personal clothing purchases. She was able to conceal the fraud because she was responsible for reviewing all expense reports, including her own. In addition, she sometimes was given ultimate responsibility for signing off on the expense report when her boss was too busy. Also, because she controlled the budget, when she submitted her expenses, she coded them to budget items that she knew were running under budget so that they would not catch anyone's attention. She was able to take $275,000. She must have a nice wardrobe if she was buying wardrobes. So the miscontrol, independent internal verification. Her boss should have verified her expense reports. When asked what he thought her expenses were, the boss said about $10,000. At $115,000 per year, her actual expenses were more than 10 times what would have been expected. However, because he was too busy to verify her expense reports or review the budget, he never noticed that difference. So having good controls over expense reimbursement process is important. One of the jobs I worked at, I was responsible for not only approving my employees that reported to me expense reports, I independently would have to verify any expense report over a certain dollar amount. I think it was like $5,000. So if someone turned in an expense report for $5,000 or more, their immediate supervisor would approve it, and then before it got processed for payment, it would come to me. This was an online system, so it was easier to do than a paper system, but I would get notification, and then I would have to review that to make sure everything was followed. So it was an independent verification of that. And in fact, I had to reject one of our CEO's expense reports one time because the documentation wasn't correct. So I had to send it back to him, talk to him about it. He got the right documentation, submitted it, and it went through. But just having that independent internal verification saved some questions down the road. If I would have just approved it without that and it got picked for audit, we both could have gotten in trouble because it could have looked like we were trying to commit fraud, even though it was an honest mistake. Human resources controls. So these are things like issuing a bond on employees who handle cash. What that means is it's not a bond that we're going to talk about in future chapters where we raise money. It's kind of an insurance against that person. So it's a third party that they say they issue the bond, that they're guaranteeing that if anything is stolen in cash by that employee, that this third party will cover it. So they do background checks and that type of thing. Rotate employees' duties and require vacations. So it's a good idea to have employees make sure they take vacations. That's where a lot of fraud is uncovered when someone takes vacations and someone else has to fill in and do the work. And we'll see an example of that in a minute. And then conduct background checks. So make sure you run background checks on your employees if there's things that they've been convicted of crimes or fired from previous jobs for something, and we're going to do the same thing here. It may not be the best, thing to hire that person doing that same type of work. It will, it's not an absolute that they can't be hired, but it's just something to be aware of. Another data point. So Excelsior N. So Ellen Lowry and Josephine Rodriguez. So Ellen was the desk manager, Josephine was head of housekeeping at this luxury hotel. Two best friends were so dedicated to jobs that they never took vacations. They frequently filled in for other employees. In fact, Josephine, whose job as head of housekeeping, did not include cleaning rooms, often cleaned rooms herself, just to help the staff out and help them keep up. So good employee pitching in. Ellen, the desk manager, provided significant discounts to guests who paid with cash. She kept the cash and did not register the guest in the hotel's computerized system. Instead, she took the room out of circulation due to routine maintenance. Because the room did not show up as being used, it did not receive a normal housekeeping assignment. Instead, she would tell Josephine where these rooms were. She would go clean those rooms during the guest stay, and they would split the cash. So $95,000 was the take. The miscontrol is human resource controls. Ellen, the desk manager, had been fired by a previous employer. If they had conducted a background check, they may not have hired her into that role. The fraud was detected when Ellen missed work for a few days due to illness. System of mandatory vacations and rotating days off would have increased the chances of detecting the fraud before it became so large. So because she wasn't there, I'm guessing the guest came to the desk or came to another employee and asked for something. They had no record of them in their system that they were staying there. So it was uncovered that way is what my guess was. So having employees take vacations means that you'll uncover these types of things that they're hiding by being there every day. SOX boosts the role of human resources. Under SOX, a company needs to keep track of employees' degrees and certifications to ensure that employees continue to meet the specified requirements of the job. Also, to ensure proper supervision and proper separation of duties, companies must develop and monitor an organizational chart. So again, SOX is the Sarbanes-Oxley Act. It's referred to as SOX, not the White Sox on the south side. When corporation went through this exercise of looking at the organizational chart, it found out of 17,000 employees, 400 people who did not report to anyone. So they had 400 people working, getting paid, but they had no immediate supervisor. The corporation also had 35 people who reported to each other. So someone reported to me, I reported to them. We can commit fraud because we're checking each other. In addition, if an employee complains of an unfair firing and mentions financial issues at the company, Human Resource Department must refer the case to the company audit committee and possibly its legal counsel. So I had an example where one of our plant managers at one of the plants, I was the VP of finance of the organization. I got a call one day from our legal counsel and said that they had an employee, or I think it was an ex-employee at that plant. It was actually the person's girlfriend had called our ethics line, our compliance line, and said that the plant manager was stealing from the corporation. So yeah, it could be just a disgruntled employee trying to raise some problems for the plant manager because they were fired, but our policies were in place where it went to legal. They had to investigate it. They involved me because I was the head of finance, so we had to do an audit on this employee. And when I talked to the plant manager's boss, our VP of operations, and said this has been brought up, we need to do investigation. He said, yeah, I've got an expense report that doesn't look right that I haven't approved yet. I just haven't had the time to do anything with it, but he hadn't approved it. So we started looking at the expense report. We looked at other expense reports. We had to go down and interview some of the employees at the plant. Ended up firing the plant manager because there was fraud going on. We found instances where he was having his people that reported to him, actually a new person, newly hired into the company, um, it said, hey, this is how we do things. You buy this for me. I'll approve your expense report, and we don't have to tell corporate about it. He had been buying iPads that supposedly were supposed to be gifts for employees, but no employee received it. Um, he had told a vendor that clean the inside, help clean the inside of the plant. Hey, if you buy a mower that you can do landscaping and cut the grass, that contract's coming up soon, and I'll give you that contract for the company if you do that. But and you could probably keep the mower on site here since we're the first one that you're doing that for, but I don't want the other company to know yet, so why don't you order it and deliver it out to my farm? So he had this new tractor that apparently he was using at his farm. So there's a lot of things that were going on that we uncovered after we did the investigation, and it all came through kind of having this compliance line, which was part of Sarbanes-Oxley. In our implementation of that, we had a compliance line. Someone called, we did the full investigation and found the fraud. So a lot of interesting things that I've seen in my career. So why would unsupervised employees or employees who report to each other represent potential internal control threats? An unsupervised employee may have a fraudulent job or may even be a fictitious person. So you heard about ghost payroll, so someone drawing a paycheck without working. If two employees supervise each other, there's no real separation of duties, and they can conspire to defraud the company. Data analytics and internal controls. Many companies employ continuous monitoring of virtually every transaction. Spikes in certain types of activity or developing trends are more quickly identified and investigated. Many different aspects of journal entries can be monitored continuously. Large dollar amounts in risky areas can also be flagged and investigated quickly. So using the data analytics and for internal controls can help identify things quickly and before they get too out of hand. Limitations of internal control. So the cost should not exceed the benefits. That is one thing that I'm a little bit not the biggest fan of the Sarbanes-Oxley Act. I think in a lot of cases the cost exceed the cost of implementing that exceed the benefits. There's a lot of cost in segregation of duties, and there's a lot of paperwork that needs to be maintained in a true SOX environment. So there's physical paper that needs to be signed off on and that type of thing that it's just driving cost in the business that, yes, the control is necessary. I'm not arguing that there shouldn't be controls, but just how you implement those controls and how you prove that those controls are in place, I think can be done in a cheaper way, but the SOX environment doesn't allow for that. Well, a human element is also a limitation. So if someone is trying to prevent or commit fraud, there's ways around controls, and humans will try and find ways around those controls. No matter how good the control is, there's always, if someone has the right opportunity to do it, there's a chance that fraud is going to be committed. And the size of the business. So we talked about establishment of responsibilities and segregation of duties. In a smaller company, you may not have the number of people required to have those separations. So there may be other controls that you have to put in place on the backside to do monitor some of the things that a separation of duty would be successful on. But if the business is too small, they may not be able to have that true segregation. Controls may vary with the risk level of activity. Management may consider cash to be high risk and maintaining inventories in the stockroom as low risk, Thus, they would have stricter controls on cash than they would have in the stockroom inventory. So that's that risk assessment we spoke about earlier. You do that and you put the controls in place where it's high risk. So let's look at some examples here. Identify the principles of control activities are violated in each of the following situations and explain how each situation creates an opportunity for fraud. So the person with primary responsibility for reconciling the bank account and making all bank deposits is also the company's accountants. So violate segregation of duties control principle. So making the bank deposits, reconciling the bank account, and the accountant record keeping should be separate from physical custody. The employee could embezzle cash and make journal entries to hide the theft. So of those three activities, reconciling, making the bank deposits, and the accountant recording the transactions, at a minimum, one of those should be done by a different person. So Wellstone Company's treasurer received an award for distinguished service because he had not taken a vacation in 30 years. It violates the human resource control principle where they're making key employees take vacations. The treasurer who manages the company's cash might embezzle cash and use his position to conceal the theft. So my son he works from Goldman Sachs now, investment banking. They have a policy, and most large banks have this policy where he has to take within a 12-month calendar year 5 days consecutive vacation, and it's considered a no contact period. So he cannot check his email, he can't answer his phone for work business. No one can contact him from the business. So the bank says the 5 days that they have to do that, and this is why they do that, is to make sure they take vacation, and anything they're working on over 5 days would probably be uncovered if there's fraud going on in that type of thing. In order to save money spent on order slips and reduce time spent keeping track of order slips, a local bar or restaurant does not buy pre-numbered order slips. Okay, so what's the control that's violated? The documentation procedures. Remember, that's got the pre-numbered invoices and that type of thing. If pre-numbered documents are not used, it's virtually impossible to account for all the documents. An employee could write up a dinner sale, receive the cash from the customer, and then throw away the order slip and keep the cash. So a lot of times you see restaurants now, the waiter and waitresses carry around a small computer handheld thing. They can put the order in there. It goes back to the kitchen. That's all controlled. They don't need pre-numbered because of that. Other restaurants where they're still writing the order down, then they go to a computer and enter it. Well, that or entering into the computer is the control. So it doesn't necessarily have to be pre-numbered because the food doesn't get made and given to the customer until it gets into the computer system. And then there are still some places that will write out the slip, give it back to the kitchen. They make the dinners or the meals based on those slips. Those should be the pre-numbered ones. So different ways you can control that in a restaurant environment like that. So now we'll talk about applying internal control principles to cash. We've touched on a couple of those with some of our examples, but now we will actually go through and see what it looks like as we apply these to the cash. So establishment of responsibility. Authorize only designated personnel to handle the cash receipts. Segregation of duties. Have different individuals handle cash and record cash receipts. Documentation procedures. Use remittance advice, mail receipts, cash register tapes, point of sale, POS, system reports, and deposit slips or confirmations. Physical controls. Store cash in safes with limited access. Use cash registers or point of sale terminals and deposit cash daily. Independent internal verification. Supervisors count cash receipts daily. Accountant compares total receipts to bank deposits daily. In human resources controls, bond personnel who handle cash require employees to take vacations, conduct background checks on employees. So those are all examples of controls that we can put in place around cash. Over-the-counter receipts. So control of over-the-counter receipt center on cash registers. Most retail businesses receive payments with cash, credit cards, or debit cards. All sales must be entered into a register through the point of sale POS software. At the end of the shift, staff members count the cash to ensure it agrees with the amount reported in the system. And then a supervisor double checks the amount and prepares the deposit slip. Electronic receipts. Electronic funds transfers, or EFT, uses wire, telephone, or computers to transfer funds from one location to another. Businesses rely on their banks to maintain strong internal controls to safeguard cash, and EFTs reduce some of the opportunities for employee theft. So you're not receiving cash, you're getting transfers electronically directly into your bank, you're paying vendors electronically, so there's no physical check that's going out. So that's just all ways that you can improve your controls and reduce the touch points for potential fraud. Check receipts. Checks received at the time of sale are included in the cash register and form part of an employee's reconciliation of daily sales to cash on hand. Checks received in the mail are usually accompanied by a remittance advice. Mailroom employees send the remittance advice to the accountants responsible for recording the cash receipts. Another employee then deposits the checks at the bank. An even better way on receipts is to set up a lockbox. So a lockbox is through your bank. It's and you'll see this if you pay any bills via check, which I know is very rare these days. It's more automatic through your bank, Venmo, PayPal, that type of thing. But if you look at some of your bills for utilities or something, it's probably a PO box or a strange looking address. Those are lock boxes where it goes to the bank, and it's the bank that actually will scan the remittance advice and send that to the company, and the bank, and the check is deposited directly into your account. So company employees don't ever see that check that's received, and they don't ever see that remittance advice. And you can get it set up so it's done automatically, and then it can even have a file sent into your computer system to match up the receipt to your accounts receivable. A review question. Permitting only designated personnel to handle cash and to handle cash receipts, is an application of the principle of segregation of duties, establishment of responsibility, independent check, or other control. And this answer is establishment of responsibility. Okay, if you said segregation of duties, again, I mentioned that those are closely are close to each other, but having a designated person handle the cash receipts is the establishment of responsibility. Segregation of duties would be having whoever handles the cash receipts not make the deposits or not record the transactions in the accounting system, something like that. So that would be the segregation of duties. So again, they're very close to each other, but just think about what the control is trying to do. So this is saying only certain people can handle cash. So we're establishing that responsibility. Here's another example. L.R. Cortez is concerned about the control over cash receipts in his fast food restaurant, The Big Cheese. The restaurant has 2 cash registers. At no time do more than 2 employees take customers' orders and enter sales. Work shifts for employees range from 4 to 8 hours. Cortez asks your help in installing a good system of internal control over cash receipts. So what do you think they should do to put in good internal controls over the cash receipts? So Cortez should assign a separate cash register to each employee at the start of each work shift. Since they have two cash registers and only two employees at a time take customer orders, they each should have their own. So they're not working on each other's cash register or dealing with cash. Each employee should have access only to the assigned register drawer to enter all the sales. And each customer should be given a receipt. At the end of the shift, the employees should do a cash count. Okay, the customer is given a receipt. There's a copy of that receipt internally on the cash register. So you do a cash count. You should know how much cash is in there based on what went through sales and what was received and what was given out in cash. Cash disbursement controls. Generally, internal control over cash disbursements is more effective when companies pay by check or electronic funds transfer rather than by cash. So we talked about receipts of checks and receipts of electronic funds. I touched on a little bit payments by check and electronic funds. We'll see more about that here in this section. One exception is payments for incidental amounts that are paid out of petty cash. So here's examples. Establishment of responsibility. Only designated personnel are authorized to sign checks. So the treasurer, for example, and approve vendor invoices. Segregation of duties. Different individuals approve and make payments. Check signers do not record disbursements. Documentation procedures. Using pre-numbered checks and account for them in sequence. Each check must have an approved invoice. Require employees to use corporate credit cards for reimbursable expenses, stamp invoices as paid. Physical control, store blank checks in safes with limited access, print check amounts by machine in indelible ink. Independent internal verification, compare checks to invoices, reconcile bank statement monthly. And human resource controls. Again, we saw these before. Bond personnel who handle cash. Require employees to take vacations, conduct background checks. So I got another story for you. I have a lot of stories around internal controls and fraud because being in finance, you see a lot of it. So the only designated employees authorized to sign checks. At one of my previous jobs, I was authorized to sign checks. The way we did it was I made my signature, we scanned it, we put it into the computer system, and the computer system actually printed the check and with my signature. I left that company, but they asked me to come back and do some consulting for them, so I became a consultant at the company. I had set up my own consulting company, provided an invoice to be paid, received my first check before we set up electronic funds into my company's bank account. I actually received a physical check, and I opened the check. I look at it. I had signed the check. So check was made out to me. I had signed the check because they hadn't changed that yet. So knowing the internal controls was an issue, I had to document that. I Xeroxed the check, wrote an email, sent a scanned copy back and said, hey, guys, this is made out to me. I'm also the signer, but I'm no longer an employee. I shouldn't be a signer. I should be off the bank account. So I just wanted to document that. So they know it wasn't fraud, that I was trying to write a check to myself. But that's an example of it was convenient that we had my electronic signature when I worked there, and I didn't have to physically sign every check. But if it didn't get changed in time, it looks like I was writing a check to myself. So the use of pre-numbered checks and dispersing cash is an application of the principle of which one of these? Segregation of duties, establishment of responsibility, physical, mechanical, and electronic controls, or documentation procedures? And the answer is documentation procedures. You're using pre-numbered checks. So you can see if there's one out of order or one missing and that type of thing. Voucher system controls. This is a network of approvals by authorized individuals acting independently to ensure all disbursements by check are proper. A voucher is an authorization form prepared for each expenditure. A voucher system involves two journal entries, one to record the liability in the voucher register and a second in the check register to pay the liability. Okay, so this is kind of, again, prior to strong computer systems or maybe a smaller company. You get an invoice potentially from a vendor that you need to pay. It's creating a form to show who's being paid, what they're being paid for, and then routing that for approval. So it would say, you know, we're buying supplies, office supplies for the office, and then it would potentially go to one or two people for approval, different from the people that are receiving the office supplies in and ordering the office supplies. So there's a trail of people entering and approving that voucher. Then someone records the journal entry to show that we got supplies and set up the liability. So that's the debit to supplies, credit to accounts payable. And then when that voucher, that invoice is paid, someone else is recording the check, creating the check, signing the check to pay that invoice and that voucher, and then debiting cash, crediting accounts payable to relieve that liability. Again, with computer systems, a lot of that is done automatically through the system. I have a system that I work with in my current company that if an invoice comes in that doesn't have a purchase order with it, so we can't do the three-way match with the purchase order and the receipt through the system, it gets put through for approval. As controller, I'm seeing all of those. So depending on the type of expenditure it is, it'll go to somebody else for approval. And then anything, then everything comes to me. So even if it's $1 up to $10,000, I have approval. If it's less than $10,000, I'm the last approver, and it goes through to get paid. If it's more than $10,000, then it goes on to someone else for approval, my general manager. He has up to $25,000. Above that, it goes to our president of our division. So there's a lot of approvals. I think our biggest ones will go through 5 people for approval. So 5 different people will look at the invoice, see what it's for, and make that approval. And it's all done in the system. An invoice for $200, for example, potentially could be me just approving it. If it's a freight invoice, for example, there'll be 2 people. There'll be someone that handles the freight to say, yeah, that is a legitimate freight invoice, and then I see it as well. So a lot of controls in place on getting payments out. So petty cash. Petty cash is used to pay small amounts. The company I work with currently, we have a small petty cash fund. It's about $500. Other companies I've worked for, they've just done away with petty cash, and you know, the small types of payments they either didn't have or made the employee pay for it out of pocket, and then turn in an expense reimbursement form to get reimbursed. So if we have a petty cash fund, some steps we have to take. We have to establish the fund. We have to make payments for the fund, and then we replenish the fund. So petty cash funds are authorized and legitimate. They're not slush funds. Slush funds are unauthorized and hidden under the table. That's not what petty cash is. It's legitimate and authorized transactions. What we use it for is for potentially individuals that aren't set up in our expense reimbursement system, so they can't turn in funds and get reimbursed that way. So some of our factory workers, if they very rarely travel, or we may not set them up. So if they take a trip, a special trip, they may get reimbursed that way. Someone goes out and buys ice for the factory on a hot day or something. It just may be a worker that we send out to do that. They pay it out of pocket and then turn the expense in for the petty cash reimbursement. So here's an example. We're established the petty cash fund. Laird Company decides to establish a $100 fund on March 1st. The entry is to debit petty cash, credit cash. Okay, what it really entails is going to the bank, withdrawing $100 from your bank account. So you have $100 cash. This is the journal entry to show that. Petty cash is a asset account. It's not an expense account. So we're showing that we take cash out of our bank account, the cash account, and put it into petty cash. On March 15th, Laird's petty cash custodian requests a check for $87. The fund contains $13 cash and petty cash receipts for postage of $44, $38 for freight, and miscellaneous expense for $5. So they have $13. The fund, petty cash fund, is $100 that we saw on the previous slide. So to get from 13 to 100 is $87 to replenish the cash back to $100. So we request it. At this time, we're going to record the expenses. Our postage of 44, freight of 38, miscellaneous expense 5. So we're going to debit those accounts for those amounts and credit cash 87 for the check that's given, then is cashed, and the cash is put into the petty cash box. Okay. Assume the preceding example that the custodian only had $12 in cash plus the receipts that we had. So the request for reimbursement would be for $88, because to go from 12 to 100 you need $88. So we're going to credit cash 88 instead of the 87. We still have our debits to the expense accounts, postage, freight out, and miscellaneous expense for the amounts that we had before. We need another debit of $1 to make the entry balance, because debits have to equal credits. We put that to an account called cash over and short. So it's a debit of $1. Okay, so it's an expense account. We had $1 we couldn't explain. It's immaterial, so we don't worry about it. We will monitor that account. If that keeps growing, then we may have some fraud going on. So it's a way we can monitor that to make sure someone isn't stealing our petty cash. But if it's just a rounding error, or we forgot a receipt, lost a receipt, that type of thing for a small amount, we just let it go to that expense account. 3 types of fraud. So occupational fraud is using your own occupation for personal gain through the misuse or misapplication of the company's resources or assets. This type of fraud is one of 3 types: asset misappropriation, corruption, or financial statement fraud. So asset misappropriation is the theft of cash on hand, fraudulent disbursements, false refunds, ghost employee, personal purchases, fictitious employees. It's the most common but the least costly. So they're usually smaller dollar amounts in each act of fraud. It's very common because it's easier for employees to have opportunity to do that. And good controls will catch these and limit the amount of fraud. Corruption, things like bribery, illegal gratuities, economic extortion, generally falls in the middle between asset misappropriation and financial statement frauds as regards to frequency and cost, and then financial statement fraud. So fictitious revenues, concealed liabilities and expenses, call that off-balance sheet transactions, improper disclosures, improper asset values. This occurs less frequently than other types of fraud, but it is the most costly. So if we look at this following graph here shows the frequency and the median loss for each type of occupational fraud. So misappropriation, it's 86% of the fraud, so it's most of the fraud. The median loss is $100,000. Corruption, 50% of the cases, the fraud cases is corruption. A little bit more, 150,000 is the median loss. And then finally, financial statement fraud. It's only 9% of the fraud cases, but it's by far the biggest. The median loss is $593,000. Now, this adds up to more than 100% because some of the fraud cases can be classified into more than one category. So they did that so that it's not 100% total. How can companies reduce the likelihood of occupational fraud? To reduce the occurrence of fraudulent disbursements, companies should follow the procedures discussed in this chapter. Only designated personnel sign checks, having different personnel approve payments and make payments, ensuring that check signers do not record disbursements, using pre-numbered checks and matching each check to an approved invoice, storing blank checks securely, reconciling the bank statement, and stamping invoices paid. So then the invoice doesn't get paid twice. Let's look at an example around the petty cash fund. Batir Company established $50 petty cash fund on July 1st. On July 30th, the fund had $12 cash remaining in petty cash receipts for postage, $14, office supplies, $10, delivery expense to customers, $15. Prepare the journal entries to establish the fund on July 1st and replenish the fund on July 30th. So on July 1st, we established the fund for $50. Do you remember what that journal entry is? It's a debit to petty cash of 50, credit to cash of 50. We then, on July 30th, we had $12. In order to get back to 50, we need $38, so we're going to request a check for $38. We're going to credit cash down at the bottom there. 50 minus 12 is $38. We're going to record the expenses. So we had postage expense, $12 or $14, office supplies of $10, freight out of $15. That equals $39. So we have expenses and receipts for more than what we need to replenish the account to $38. So we had $39 of expense, $38 to replenish it. We use that difference. We need a credit in this case of $1. We put it to that same cash over and short account. Again, we monitor that account. If we have $1 debit in 1 month, we may have $1 credit in the other, so it zeroes out. But we're just monitoring that to make sure it doesn't get too large and there's not a consistent overage or short in there that would then indicate potentially fraud. Learning objective 3, identify control features of a bank account. Use of a bank contributes significantly to good internal control over cash. Minimizes the amount of cash on hand, creates a double record of bank transactions, and there's a bank reconciliation. Essentially, the bank statement is a copy of the bank's records sent to the customer or available online for review. Making bank deposits. Authorized employees should make the deposit. So here's a deposit slip. So it shows the company, the date, the amount of the deposit. There's some currency, there's some coins, total of checks. It shows that in the bank on the reverse side for the bank, what the total is that's brought over. So this is good control showing how much the deposit is. Writing checks, okay. Written order signed by a depositor directing bank to pay a specified sum of money to a designated recipient. Okay, so this is a handwritten one that has the date, It has the payee, the maker here is the company writing the check. Here's the dollar amount in numbers. We then also write out um, the dollar amount. The payer is the bank that it's coming out of, and then we have a signature here. Here is the remittance advice. So it's telling Watkins Wholesale Supply what we're paying. We're paying invoice number 27662. The gross amount, we didn't take a discount, and that's the net amount that we're paying, so what the check is for. Potentially, you could pay more than one invoice on one check. In that case, you would list the next invoice. The total of the net amount would be how much the check is for. Electronic banking. Most businesses take advantage of electronic banking using computer or mobile banking. Banks must ensure that these websites are secure and require users to have strong passwords and change passwords frequently. Businesses must incorporate strong internal controls over remote deposit capture, safeguarding checks, and documenting the use of cash withdrawn from the ATM. Bank statements are prepared from the bank's perspective. So if you see debits and credits on a bank statement, it's from the bank's perspective, not the company's perspective, so it's going to be opposite. Every deposit the bank receives is an increase in the bank's liability, an account payable to the depositor. So a credit for the bank is actually a debit for the company. So it may show credits on the bank statement, but that's debits to the company. So it lists in numerical sequence all paid checks along with the date the check was paid and its amount. Bank includes with the bank statement memoranda explaining other debits and credits it made to the depositor's accounts. A check that is not paid by a bank because of insufficient funds in a bank account is called an NSF check, not sufficient funds. Okay, so if a customer gives you a check, you deposit it, the bank's going to show that you have that in your account. They're going to take it to the payer bank and request that money. If there's not sufficient funds in that bank will say, I don't have enough money to pay that. Your bank then would take that out of your account, and that would be shown as an NSF check. Here's an example of a bank statement. So in name of the bank, the name of the company, the account that's holding it, and Laird Company in this example. Here's the account number, shows the last statement, shows the total deposits and credits, the total checks and debits, and then the balance for this statement. It lists by number all of the checks, the deposits in order. So you see there's some with check numbers, some with EFT, the same with deposits. These are deposits made either in cash or check. EFT is an electronic funds deposits, what the daily balance is, and symbols of what some of these mean. There is an NSF 42560. So a review question. The control features of a bank account do not include A, having bank auditors verify the correctness of the bank balance per books, minimizing the amount of cash that must be kept on hand, providing a double record of all bank transactions, safeguarding cash by using bank as a depository. So which of these is not a control feature of a bank? The answer is A, having the bank auditors verify the correctness of the bank balance per books. That is the company's responsibility to do that reconciliation, not the bank auditors. So if we talk about reconciling the bank account, so we reconcile the balance per the books and the balance per bank to the correct or true balance. 4 reconciling items we're going to talk about: deposits and transits, outstanding checks, and bank memorandum. So these are all time lags. So they're going to be recorded on either the bank first or the books first, and the reconciliation process takes up that time lag, and then errors is the other one. So if we look at the cash balances, we're going to have on the left side, per the bank statement, it's going to have what the balance is in the account on the bank statement. We're going to have deposits and transits that we're going to add to that balance. We're going to subtract outstanding checks and then identify if there's any bank errors. It could be a plus or a minus to that bank statement. That gives us our correct cash balance. If we then take the balance per the books, we're going to add EFT collections and other deposits that are on the bank statement that we hadn't recorded yet on our books. We're going to subtract any NSF or bounced customer checks. We're going to subtract any service charges and other payments that the bank took out of our account, and then identify any errors in our records. It could be either a plus or a minus to our book balance. That's going to give us the correct cash balance. And if we do the reconciliation properly, we're going to come to the same correct balance in both instances. So the presented bank statement for Laird Company we saw a few slides before is accessed online. Shows a balance per bank of $15,907.45 on April 30th, 2027. So let's flip back to that view. So this is what we're talking about, this bank statement. Here's the balance, the $15,907.45. Okay. On this date, the balance of cash per the books is $11,709.45. Okay, so we have a difference between the bank and the books, and that's pretty common. From the foregoing steps, Laird determines the following reconciling items for the bank. Deposits in transit is an add. So April 30 deposit received by the bank on May 1st, 2002-0140. So this is an example is if we took our cash receipts for the day, took it to the bank. A lot of banks have a night depository slot where you can put cash deposits or check deposits in. It gets put into the bank. It's safeguarded there, so it's out of your hands. But if you do it after the bank closes, they're going to record it the next day on the bank books. So it'll be on your May statement. The bank's going to show it as May 1st, even though you collected the cash on April 30th and recorded it on your books April 30th. Outstanding checks. So we have 3 outstanding checks, number 453, 457, and 460, total 5,904. So these are checks that we wrote, recorded that we wrote the check on our books, gave it to our vendors either through mail or handed it to the vendors. They have not cashed and cleared the bank, so they have not been taken out of our bank balance yet. So we're going to subtract that from the bank balance on the bank statement, and then we didn't have any bank errors in this case. We looked at our books and we had reconciling items from our books. So we had unrecorded electronic receipt from customer on account on April 9th determined from the bank statement. So we looked through the bank statement, saw electronic funds deposit. We had not recorded it yet. So it happened on April 9th. We're going to record that on our books, 1,035. Other payments. So there was electronic payments on April 3rd and April 7th, previously recorded by the company when they were initiated. Unrecorded charges, so we took care of those already on our books, but we had unrecorded charges determined from the bank statement as follows. So we returned non-sufficient check on April 29th. So the bank took that out of our balance because when they took it to the customer's bank, they didn't have enough funds, so they took it out. It was debit and credit card fees on April 30th, $120, and a bank service charge on April 30th, $30. Company errors. So check number 443 was correctly written for $1,226. correctly paid by the bank for that amount. However, we noticed that it was recorded on our books for 1,262. So we took too much money out of our book balance by $36, so we're going to add $36 back to our cash balance. So these are all the reconciling items. We do the bank reconciliation. We take the cash balance for the bank statement, that $15,907.45. We're going to add the deposits and transits. We're going to subtract the outstanding checks and say that the adjusted cash balance for the bank is this $204.85. Then we look at the book cash balance, the $11,709.45. We're going to have the error that we add and the electronic funds received by the bank that we didn't record yet. So we're going to add 1,071. Then we're going to subtract the NSF check, debit and credit card fees, and the bank service charge. So $575.60 total. And our adjusted cash balance per books is $12,204.85. That is the correct balance, and that equals our adjusted cash balance per the bank. And we've reconciled the bank statement. Now we have to record some entries. The payment of an account by a customer is recorded in the same way, whether the cash is received through the mail or electronically. The entry that we're going to record is debit cash, credit accounts receivable. So that cash received into the bank directly, we put on our reconciling or cash or reconciliation here. We have to make the entry for that. Next, we'll look at the book error in the NSF check. So the cash disbursement journal shows that a check number 443 was payment on account to Andrea Company as a supplier. The correcting entry is the debit cash credit accounts payable. So remember, we recorded the check for more than what the check was written for. So we took too much cash out of our book balance and we reduced accounts payable too much. So now we're adding that cash back to our book balance and showing the correct accounts payable amount. Then the NSF check becomes an accounts receivable to us. So we received cash from a customer, deposited in the bank, recorded either the sale or the payment on account, where we debited cash, credit accounts receivable, or credited cash revenue. That check bounced, so the cash was taken out of our bank account by the bank. We have to record that on our books, and we do that by debiting accounts receivable. So now we're going to go to our customer and say, you still owe us that amount because the check bounced, and we're going to reduce our cash on our books, the $425.60, by crediting cash. And finally, we'll look at the bank service charge, fees for processing debit and credit card transactions, and the bank service charge. We combine that into a single entry. We're going to debit bank charge expense, $150, credit cash, $150, to show that that cash went out. So if we look at the cash balance, the cash account, we had a balance initially of the $11,709.45. We went through the reconciliation process. We booked 4 entries. All those correcting entries adjusting entries went to cash as one side of the transaction, because that's what we're reconciling. And we had 2 debits and 2 credits. The new balance is our reconciled balance, $12,204.85. Review question: the reconciling item in a bank reconciliation that will result in an adjusting entry by the depositor is it outstanding checks, deposit in transit, a bank error, or bank service charges? So which one of those reconciling items result in an adjusting entry by the company? And it's the bank service charges. So all those others are reconciling items when we take the bank balance from the bank statement and get to the adjusted. We do not do entries for those. Those are all timing errors, and then an error potentially that we have to identify to the bank that they need to correct on their side. But a bank service charge is an adjusting entry or a adjusting entry book on our books because it adjusted our book balance. Madoff. If you haven't heard of uh, Bernard Madoff yet, you should look that up. It's an interesting scheme. He created a Ponzi scheme. Um, he was an investment banker, a fund manager, highly regarded by security regulators. Investors flocked to him because he delivered steady returns between 10 and 15%, no matter what the market, if the market was going up or down. Many years, Madoff did not actually invest the cash that people gave him. Instead, he was running a Ponzi scheme. He paid returns to existing investors using cash received from new investors. As long as the size of the investment fund continued to grow from new investments at a rate that exceeded the amounts he needed to pay out in returns, he was able to operate his fraud smoothly. He fabricated false investment statements that were provided to investors, hired an auditor that never verified the accuracy of the investment records but automatically issued unqualified opinions. A competing fund manager warned the SEC a number of times over a nearly 10-year period that he thought he was engaged in fraud. The SEC never aggressively investigated. The investors, many of which were charitable organizations, lost more than $18 billion. He was sentenced to a jail term of 150 years and then subsequently died while he was in jail. How was he able to conceal this? He fabricated false investment statements that were provided to investors. His auditor never verified these investment statements, even though the auditor issued unqualified opinion each year. So he had someone helping him through the auditors and committed that fraud. So let's look at a bank reconciliation example. Sally Kist owns Linen Kist Fabrics. She asked you to explain how she should treat the following reconciling items when reconciling the company's bank account: a debit memorandum for an NSF check, credit memorandum for electronic funds transferred from one of the company's customers that received by the bank, outstanding checks, and deposit in transit. So how do we handle these four items when we do the bank reconciliation? The NSF check, we deduct from the balance per books, so it's a book adjustment. Electronic funds transfer received by the bank, we're going to add that to the balance per the books. So that bank received that, it's on the bank statement, we haven't recorded it yet. The outstanding check, that's checks that we wrote but hasn't cleared the bank yet, so we deduct it from the bank balance per the bank. And deposits in transit, again, deposits that we recorded and made but didn't show up on the bank statement, so we add to the balance per bank. The first two, we will also do journal entries to adjust the book balance to the correct balance. The other two, we don't do any entries for. So reporting of cash, our last objective here. Cash consists of coins, currency, paper money, checks, money orders, money on hand, or deposits in a bank or similar financial institution. Cash is reported in two different statements. The balance sheet reports the amount of cash available at a given point in time, and the statement of cash flow shows the sources and uses of cash during a period of time. So we've seen the balance sheet. We haven't talked about the cash flow statement. That is chapter 12, I think, so we will see that later in the semester, but we won't talk about it now. Cash equivalents are short-term, highly liquid investments that are both readily convertible to known amounts of cash and so near their maturity that their market value is relatively insensitive to changes in interest rates. So if we have that situation, we can record that as cash equivalents. Restricted cash is cash that is not available for general use, but rather is restricted for special purposes. So cash restricted in use should be reported separately on the balance sheet as restricted cash. Here's an example from Delta Airlines. This is part of their asset section of their balance sheet. It's in millions. Under current assets, we have cash and cash equivalents, 2,844,000 million, so $2.8 billion. Short-term investments, they had $959 million, and restricted cash, $122 million. So they've put some restrictions on some of their cash for specific use. They report that separately. So which of the following statements correctly describes the reporting of cash? Cash cannot be combined with cash equivalents. Restricted cash fund may be combined with cash. Cash is listed first in the current asset section. Restricted cash funds cannot be reported as a current asset. The answer is that cash is listed first in the current asset sections, can be combined with cash equivalents, as we saw in the example from Delta Airlines, and it's reported first, cash and cash equivalents. So indicate true or false for these statements. Cash and cash equivalents are comprised of coins, currency, paper money, money orders, and NSF checks. False. NSF checks is not cash or cash equivalents. So if that was removed, it would be true. But then cash equivalents also could be highly liquid investments. Restricted cash is classified as either current asset or non-current asset depending on circumstances. We haven't talked specifically about that, but the answer is true. So if restricted cash is going to be used more than a year out, so the restriction is for, we're going to use that cash in 2 years, for example, it would be a non-current asset. 3, a company may have negative balance in its bank account. In this case, it should offset the negative balance against cash and cash equivalents on the balance sheet. That is false. Cannot have a negative balance in its bank account. The bank won't let you have a negative balance. It'll make you take a loan to cover it or something like that. So you can't have that negative balance. Because cash equivalents often include short-term investments, accounts receivable should be reported as the first item on the balance sheet. That is false. We've talked about that. Cash and cash equivalents are the first item under current assets on the balance sheet. That wraps up Chapter 7, Fraud, Internal Controls, and reporting and applying the internal controls to cash, and then the bank reconciliations. If you have any questions, let me know. Thank you.